Open a ZERODHA account. Chapter 2. Basic Option Jargons. Hindi Gujarati. 2.1 Decoding the Basic Jargons. In the previous chapter, we understood the basic call option structure. The idea of the previous chapter was to capture a few essential call option concepts such as: it makes sense to be a buyer of a call option when you expect the underlying price to increase. If the underlying price remains flat or goes down, then the buyer of the call option loses money. The money the buyer of the call option would lose is equivalent to the premium agreement fees the buyer pays to the seller, writer of the call option. In the next chapter, i.e., Call Option, Part 2, we will attempt to understand the call option in a bit more detail. However, before we proceed further, let us decode a few basic option jargons. Discussing these jargons at this stage will not only strengthen our learning, but will also make the forthcoming discussion on the options easier to comprehend. Here are a few jargons that we will look into. Strike price, underlying price, exercising of an option contract, option expiry, option premium, option settlement. Do remember, since we have only looked at the basic structure of a call option, I would encourage you to understand these jargons only with respect to the call option. Strike price. Consider the strike price as the anchor price at which the two parties, buyer and seller, agree to enter into an options agreement. For instance, in the previous chapter's AJ venue example, the anchor price was 500,000 rupees per, which is also the strike price for their deal. We also looked into a stock example where the anchor price was 75 rupees per, which is also the strike price. For all call options, the strike price represents the price at which the stock can be bought on the expiry day. For example, if the buyer is willing to buy ITC Limited's call option of 350 rupees, 350 being the strike price, then it indicates that the buyer is willing to pay a premium today to buy the rights of buying ITC at 350 rupees on expiry. Needless to say, he will buy ITC at 350 rupees only if ITC is trading above 350 rupees. In fact, here is a snapshot from NSE's website where I have captured different strike prices of ITC and the associated premium. The table that you see above is called an option chain, which basically lists all the different strike prices available for a contract along with the premium for the same. Besides this information, the option chain has a lot more trading information such as open interest, volume, bid-ask quantity, etc. I would suggest you ignore all of it for now and concentrate only on the highlighted information. The highlight in maroon shows the price of the underlying in the spot. As we can see, at the time of this snapshot, ITC was trading at 336 rupees and 90 paise per share. The highlight in blue shows all the different strike prices that are available. As we can see, starting from 260 rupees with 10 rupees intervals, we have strike prices all the way up to 480 rupees. Do remember, each strike price is independent of the other. One can enter into an options agreement at a specific strike price by paying the required premium. For example, one can enter into a 340 call option by paying a premium of 4 rupees and 75 paise per, highlighted in red. This entitles the buyer to buy ITC shares at the end of expiry at 340 rupees. Of course, you now know under which circumstance it would make sense to buy ITC at 340 at the end of expiry. Underlying price. As we know, a derivative contract derives its value from an underlying asset. The underlying price is the price at which the underlying asset trades in the spot market. For example, in the ITC example that we just discussed, ITC was trading at 336 rupees and 90 paise per in the spot market. This is the underlying price. For a call option, the underlying price has to increase for the buyer of the call option to benefit. Exercising of an option contract. Exercising of an option contract is the act of claiming your right to buy the options contract at the end of the expiry. If you ever hear the line, exercise the option contract, in the context of a call option, it simply means that one is claiming the right to buy the stock at the agreed strike price. Clearly, he or she would do it only if the stock is trading above the strike. Here is an important point to note: you can exercise the option only on the day of the expiry and not any time before the expiry. Hence, assume with 15 days to expiry, one buys ITC 340 call option when ITC is trading at 330 in the spot market. Further assume, after he buys the 340 call option, the stock price increases to 360 the very next day. Under such a scenario, the option buyer cannot ask for a settlement. He cannot exercise against the call option he holds. Settlement will happen only on the day of the expiry, based on the price the asset is trading in the spot market on the expiry day. Option expiry. Similar to a futures contract, options contract also has expiry. In fact, both equity futures and option contracts expire on the last Thursday of every month. Just like futures contracts, option contracts also have the concept of current month, mid-month, and far month. Have a look at the snapshot below. This is the snapshot of the call option to buy Ashok Leyland Limited at the strike price of 70 rupees at 3 rupees and 10 paise per. As you can see, there are 3 expiry options: the 26th of March 2015, current month, the 30th of April 2015, mid-month, and the 28th of May 2015, far month. Of course, the premium of the options changes as and when the expiry changes. We will talk more about it at an appropriate time. But at this stage, I would want you to remember just 2 things with respect to expiry. Like futures, there are 3 expiry options and the premium is not the same across different expiries. Option premium. Since we have discussed premium on a couple instances previously, I guess you would now be clear about a few things with respect to the option premium. Premium is the money required to be paid by the option buyer to the option seller, writer. Against the payment of premium, the option buyer buys the right to exercise his desire to buy or sell, in case of put options, the asset at the strike price upon expiry. If you have got this part clear till now, I guess we are on the right track. We will now proceed to understand a new perspective on premiums. Also, at this stage, one guess it is important to let you know that the whole of option theory hinges upon option premium. Option premiums play an extremely crucial role when it comes to trading options. Eventually, as we progress through this module, you will see that the discussions will be centered heavily on the option premium. Let us revisit the Ajay venue example that we took up in the previous chapter. Consider the circumstances under which venue accepted the premium of 100,000 rupees per from Ajay. News flow. The news on the highway project was only speculative and no one knew for sure if the project would indeed come up. Think about it. We discussed 3 possible scenarios in the previous chapter, out of which 2 were favorable to venue. So besides the natural statistical edge that venue has, the fact that the highway news is speculative only increases his chance of benefiting from the agreement. Time. There was 6 months' time to get clarity on whether the project would fructify or not. This point actually favors Ajay. Since there is more time to expiry, the possibility of the event working in Ajay's favor also increases. For example, consider this: if you were to run 10 kms, in which time duration are you more likely to achieve it, within 20 minutes or within 70 minutes? Obviously, higher the time duration, higher is the probability to achieve it. Now let us consider both these points in isolation and figure out the impact it would have on the option premium. News. When the deal was done between Ajay and venue, the news was purely speculative. Hence venue was happy to accept 100,000 rupees per as premium. However, for a minute assume the news was not speculative and there was some sort of bias. Maybe there was a local politician who hinted in the recent press conference that they may consider a highway in that area. With this information, the news is no longer a rumor. Suddenly there is a possibility that the highway may indeed come up, albeit there is still an element of speculation. With this in perspective, think about this. Do you think venue will accept 100,000 rupees per as premium? Maybe not. He knows there is a good chance for the highway to come up and therefore the land prices would increase. However, because there is still an element of chance, he may be willing to take the risk, provided the premium will be more attractive. Maybe he would consider the agreement attractive if the premium was 175,000 rupees per instead of 100,000 rupees per. Now let us put this in stock market perspective. Assume Infosys is trading at 2,200 rupees per today. The 2,300 call option with a 1-month expiry is at 20 rupees per. Put yourself in Venue's shoes, option writer. Would you enter into an agreement by accepting 20 rupees per share as premium? If you enter into this options agreement as a writer, seller, then you are giving the right to the buyer of buying Infosys option at Rs. 2,300 1 month down the lane from now. Assume for the next 1 month there is no foreseeable corporate action which will trigger the share price of Infosys to go higher. Considering this, maybe you may accept the premium of 20 rupees per. However, what if there is a corporate event like quarterly results that tends to increase the stock price? Will the option seller still go ahead and accept 20 rupees per as the premium for the agreement? Clearly, it may not be worth to take the risk at 20 rupees per. Having said this, what if, despite the scheduled corporate event, someone is willing to offer 75 rupees per as premium instead of 20 rupees per? I suppose it's 75 rupees per. It may be worth taking the risk. Let us keep this discussion at the back of our mind. We will now take up the second point, i.e., time. When there was 6 months' time. Clearly Ajay knew that there was ample time for the dust to settle and the truth to emerge with respect to the highway project. However, instead of 6 months, what if there was only 10 days' time? Since the time has shrunk, there is simply not enough time for the event to unfold. Under such a circumstance, with time not being on Ajay's side, do you think that Ajay will be happy to pay 100,000 rupees per premium to Venue? I don't think so, as there is no incentive for Ajay to pay that kind of premium to Venue. Maybe he would offer a lesser premium, say 20,000 rupees per instead. Anyway, the point that I want to make here, keeping both news and time in perspective, is this: premium is never a fixed rate. It is sensitive to several factors. Some factors tend to increase the premium and some tend to decrease it. And in real markets, all these factors act simultaneously affecting the premium. To be precise, there are 5 factors, similar to news and time, that tends to affect the premium. These are called the option Greeks. We are too early to understand Greeks, but we'll understand the Greeks at a much later stage in this module. For now, I want you to remember and appreciate the following points with respect to option premium. The concept of premium is pivotal to the option theory. Premium is never a fixed rate. It is a function of many influencing factors. In real markets, premiums vary almost on a minute-by-minute basis. If you have gathered and understood these points so far, I can assure that you are on the right path. Option settlement. Consider this call option agreement as highlighted in green. This is a call option to buy JP Associates at 25 rupees per. The expiry is the 26th of March 2015. The premium is 1 rupee and 35 paise per, highlighted in red. And the market lot is 8,000 shares. Assume there are 2 traders, Trader A and Trader B. Trader A wants to buy this agreement, option buyer, and Trader B wants to sell, write, this agreement. Considering the contract is for 8,000 shares, here is how the cash flow would look like. Since the premium is 1 rupee and 35 paise per share, Trader A is required to pay the total of equals 8,000 asterisk 1.35 equals 10,800 rupees per as premium amount to Trader B. Now, because Trader B has received this premium from Trader A, he is obligated to sell Trader A 8,000 shares of JP Associates on the 26th of March 2015. If Trader A decides to exercise his agreement, however, this does not mean that Trader B should have 8,000 shares with him on the 26th of March. Options are cash settled in India. This means on the 26th of March, in the event Trader A decides to exercise his right, Trader B is obligated to pay just the cash differential to Trader A. To help you understand this better, consider on the 26th of March JP Associates is trading at 32 rupees per. This means the option buyer, Trader A, will exercise his right to buy 8,000 shares of JP Associates at 25. In other words, he is getting to buy JP Associates at 25 when the same is trading at 32 rupees per in the open market. Normally, this is how the cash flow should look like. On 26th, Trader A exercises his right to buy 8,000 shares from Trader B. The price at which the transaction will take place is pre-decided at 25 rupees strike price. Trader A pays 200,000 rupees per 8,000 * 25 to Trader B. Against this payment, Trader B releases 8,000 shares at 25 rupees to Trader A. Trader A almost immediately sells these shares in the open market at 32 rupees per share and receives 256,000 rupees per. Trader A makes a profit of 56,000 rupees per 256,000,200,000 on this transaction. Another way to look at it is that the option buyer is making a profit of 7 rupees per shares 32 to 25 per share, because the option is cash settled. Instead of giving the option buyer 8,000 shares, the option seller directly gives him the cash equivalent of the profit he would make, which means Trader A would receive equals 7 * 8,000 equals 56,000 rupees per from Trader B. Of course, the option buyer had initially spent 10,800 rupees per towards purchasing this right. Hence his real profits would be equals 56,000 10,800 equals 45,200 rupees per. In fact, if you look at it in percentage return terms, this turns out to be a whopping return of 419% without annualizing. The fact that one can make such large asymmetric return is what makes options an attractive instrument to trade. This is one of the reasons why options are massively popular with traders. Key takeaways from this chapter. It makes sense to buy a call option only when one anticipates an increase in the price of an ASO. The strike price is the anchor price at which both the option buyer and option writer enter into an agreement. The underlying price is simply the spot price of the asset. Exercising of an option contract is the act of claiming your right to buy the options contract at the end of the expiry. Similar to futures contract, options contract also have an expiry. Option contracts expire on the last Thursday of every month. Option contracts have different expiries: the current month, mid-month, and far-month contracts. Premiums are not fixed. In fact, they vary based on several factors that act upon it. Options are cash settled in India. 139 responses to Open a ZERODHA account. Chapter 3. Buying a call option. Hindi Gujarati. 3.1 Buying call option. In the previous chapters we looked at the basic structure of a call option and understood the broad context under which it makes sense to buy a call option. In this chapter, we will formally structure our thoughts on the call option and get a firm understanding on both buying and selling of the call option. Before we move ahead any further in this chapter, here is a quick recap of what we learned in the first chapter. It makes sense to be a buyer of a call option when you expect the underlying price to increase. If the underlying price remains flat or goes down, then the buyer of the call option loses money. The money the buyer of the call option would lose is equivalent to the premium agreement fees the buyer pays to the seller, writer of the call option. We will keep the above 3 points in perspective, which serves as basic guidelines, and understand the call option to a greater extent. 3.2 Building a case for a call option. There are many situations in the market that warrants the purchase of a call option. Here is one that I just discovered while writing this chapter. Thought the example would fit well in the context of our discussions. Have a look at the chart below. The stock in consideration is Bajaj Auto Limited. As you may know, they are one of the biggest manufacturers of two-wheelers in India. For various reasons, the stock has been beaten down in the market. So much so that the stock is trading at its 52-week low price. I believe there could be an opportunity to initiate a trade here. Here are my thoughts with respect to this trade. Bajaj Auto is a quality fundamental stock. There is no denying this. The stock has been beaten down so heavily. Makes me believe this could be the market's overreaction to volatility in Bajaj Auto's business cycle. I expect the stock price to stop falling sometime soon and eventually rise. However, I do not want to buy the stock for delivery yet, as I'm worried about a further decline of the stock. Extending the above point, The worry of M2M losses prevents me from buying Bajaj Auto's futures as well. At the same time, I don't want to miss an opportunity of a sharp reversal in the stock price. To sum up, I'm optimistic on the stock price of Bajaj Auto, the stock price to eventually increase, but I'm kind of uncertain about the immediate outlook on the stock. The uncertainty is mainly due to the fact that my losses in the short term could be intense if the weakness in the stock persists. However, as per my estimate, the probability of the loss is low. But nevertheless, the probability still exists. So what should I do? Now, if you realize I'm in a similar dilemma that Ajay was in, recall the Ajay venue example from Chapter 1. A circumstance such as this builds up for a classic case of an options trade. In the context of my dilemma, clearly buying a call option on Bajaj Auto makes sense for reasons I will explain shortly. Here is a snapshot of Bajaj Auto's option chain. As we can see, the stock is trading at 2,026 rupees and 90 paise, highlighted in blue. I will choose to buy 2050 strike call option by paying a premium of 6 rupees and 35 paise per, highlighted in red box and red arrow. You may be wondering on what basis I choose the 2050 strike price when in fact there are so many different strike prices available, highlighted in green. Well, the process of strike price selection is a vast topic on its own. We will eventually get there in this module. But for now, let us just believe 2050 is the right strike price to trade. 3.3 Intrinsic value of a call option upon expiry. So what happens to the call option now, considering the expiry is 15 days away? Well, broadly speaking, there are 3 possible scenarios which I suppose you are familiar with by now. Scenario 1, the stock price goes above the strike price, say 2080. Scenario 2, the stock price goes below the strike price, say 2030. Scenario 3, the stock price stays at 2050. The above 3 scenarios are very similar to the ones we had looked at in Chapter 1. Hence, I will also assume that you are familiar with the P&L calculation at the specific value of the spot in the given scenarios above. If not, I would suggest you read through Chapter 1 again. The idea I'm interested in exploring now is this. You will agree there are only 3 broad scenarios under which the price movement of Bajaj Auto can be classified upon expiry, i.e., the price either increases, decreases, or stays flat. But what about all the different prices in between? For example, if as per scenario 1 the price is considered to be at 2080, which is above the strike of 2050, what about other strike prices such as 2055, 2060, 2065, 2070, etc.? Can we generalize anything here with respect to the P&L? In scenario 2, the price is considered to be at 2030, which is below the strike of 2050. What about other strike prices such as 2045, 2040, 2035, etc.? Can we generalize anything here with respect to the P&L? What would happen to the P&L at various possible prices of spot upon expiry? I would like to call these points as the possible values of the spot on expiry and sort of generalize the P&L understanding of the call option. In order to do this, I would like to first talk about, in part and not the full concept, the idea of the intrinsic value of the option upon expiry. The intrinsic value, IV, of the option upon expiry, specifically a call option for now, is defined as the non-negative value which the option buyer is entitled to if he were to exercise the call option. In simple words, ask yourself, assuming you are the buyer of a call option, how much money you would receive upon expiry if the call option you hold is profitable. Mathematically, it is defined as IV equals spot price strike price. So if Bajaj Auto on the day of expiry is trading at 2068 in the spot market, the 2050 call option's intrinsic value would be equals 2068 to 2050 equals 18. Likewise, if Bajaj Auto is trading at 2025 on the expiry day, the intrinsic value of the option would be equals 2025 to 2050 equals minus 25. But remember, IV of an option, irrespective of a call or put, is a non-negative number. Hence we leave the IV at 2025 equals 0. Now our objective is to keep the idea of intrinsic value of the option in perspective. and to identify how much money I will make at every possible expiry value of Bajaj Auto, and in the process make some generalizations on the call option buyer's P&L. 3.4 Generalizing the P&L for a call option buyer. Now, keeping the concept of intrinsic value of an option at the back of our mind, let us work towards building a table which would help us identify how much money I, as the buyer of Bajaj Auto's 2050 call option, would make under the various possible spot value changes of Bajaj Auto in spot market on expiry. Do remember the premium paid for this option is 6 rupees and 35 paise per, irrespective of how the spot value changes. The fact that I have paid 6 rupees and 35 paise per remains unchanged. This is the cost that I have incurred in order to buy the 2050 call option. Let us keep this in perspective and work out the P&L table. Please note, the negative sign before the premium paid represents a cash outflow from my trading account. Serial No. Possible values of spot premium paid intrinsic value IV P&L IV plus premium 011990 6.35 1990 to 2050 equals 0 plus 6.35 equals 6.35 02 2000 6.35 2000 to 2050 equals 0 plus 6.35 equals 6.35 03 2010 6.35 2010 to 2050 equals 0 plus 6.35 equals 6.35 04 2020 6.35 2020 to 2050 equals 0 plus 6.35 equals 6.35 05 2030 6.35 2030 to 2050 equals 0 plus 6.35 equals 6.35 06 2040 6.35 2040 to 2050 equals 0 plus 6.35 equals 6.35 07 2050 6.35 2050 to 2050 equals 0 plus 6.35 equals 6.35 08 2060 6.35 2060 to 2050 equals 10 plus minus 6.35 equals plus 3.65 09 2070 6.35 2070 to 2050 equals 20 plus minus 6.35 equals plus 13.65 10 2080 6.35 2080 to 2050 equals 30 plus minus 6.35 equals plus 23.65 11 2090 6.35 2090 to 2050 equals 40 plus minus 6.35 equals plus 33.65 12 2100 6.35 2100 2050 equals 50 plus minus 6.35 equals plus 43.65. So what do you observe? The table above throws out two strong observations. Even if the price of Bajaj Auto goes down below the strike price of 2050, the maximum loss seems to be just 6 rupees and 35 paise per. Generalization 1 for a call option buyer, a loss occurs when the spot price moves below the strike price. However, the loss to the call option buyer is restricted to the extent of the premium he has paid. The profit from this call option seems to increase exponentially as and when Bajaj Auto starts to move above the strike price of 2050. Generalization 2. The call option becomes profitable as and when the spot price moves over and above the strike price. The higher the spot price goes from the strike price, the higher the profit. From the above two generalizations, it is fair for us to say that the buyer of the call option has a limited risk and potential to make an unlimited profit. Here is a general formula that tells you the call option P&L for a given spot price. P&L equals max 0. Spot price, strike price, premium paid. Going by the above formula, let's evaluate the P&L for a few possible spot values on expiry. 2023, 2072, 2055. The solution is as follows. At 2023, equals max 0. 2023 to 2050, 6.35. Equals max 0. Minus 27, 6.35. Equals 0 to 6.35. Equals 6.35. The answer is in line with generalization 1. Loss restricted to the extent of premium paid. At 2072. Equals max 0. 2072 to 2050, 6.35. Equals max 0. Plus 2 to 6.35. Equals 22 to 6.35. Equals plus 15.65. The answer is in line with generalization 2. Call option gets profitable as and when the spot price moves over and above the strike price. At 2055. Equals max 0. 2055 to 2050, 6.35. Equals max 0. Plus 5, 6.35. Equals 5 to 6.35. Equals minus 1.35. So, here is a tricky situation. The result what we obtained here is against the second generalization. Despite the spot price being above the strike price, the trade is resulting in a loss. Why is this so? Also, if you observe, the loss is much lesser than the maximum loss of 6 rupees and 35 paise per. It is in fact just 1 rupee and 35 paise per. To understand why this is happening, we should diligently inspect the P&L behavior around the spot value, which is slightly above the strike price, 2050 in this case. Serial No. Possible values of spot premium paid intrinsic value, IV, P&L, IV plus premium. 01, 2050, 6.35, 2050 to 2050 equals 0 plus 6.35 equals 6.35. 02, 2051, 6.35, 2051 to 2050 equals 1 plus 6.35 equals 5.35. 03, 2052, 6.35, 2052 to 2050 equals 2 plus 6.35 equals 4.35. 04, 2053, 6.35, 2053 to 2050 equals 3 plus 6.35 equals 3.35. 05, 2054, 6.35, 2054 to 2050 equals 4 plus 6.35 equals 2.35. 06, 2055, 6.35, 2055 to 2050 equals 5 plus 6.35 equals 1.35. 07, 2056, 6.35, 2056 to 2050 equals 6 plus 6.35 equals 0.35. 08, 2057, 6.35, 2057 to 2050 equals 7 plus 6.35 equals plus 0.65. 09, 2058, 6.35, 2058 to 2050 equals 8 plus 6.35 equals plus 1.65. 10, 2059, 6.35, 2059 to 2050 equals 9 plus 6.35 equals plus 2.65. As you notice from the table above, the buyer suffers a maximum loss Rs. 6.35 in this case, till the spot price is equal to the strike price. However, when the spot price starts to move above the strike price, the loss starts to minimize. The losses keep getting minimized till a point where the trade neither results in a profit or a loss. This is called the break-even point. The formula to identify the break-even point for any call option is B equals strike price plus premium paid. For the Bajaj Auto example, the break-even point is equals 2050 plus 6.35 equals 2056.35. In fact, let us find out the P&L at the break-even point. Equals max 0. 2056.35 2050 6.35 equals max 0 plus 6.35 6.35 equals plus 6.35 to 6.35 equals 0. As you can see, at the break-even point we neither make money nor lose money. In other words, if the call option has to be profitable, it not only has to move above the strike price, but it has to move above the break-even point. 3.5 Call option buyers payoff. So far we have understood a few very important features with respect to a call option buyer's payoff. I will reiterate the same. The maximum loss the buyer of a call option experiences is to the extent of the premium paid. The buyer experiences a loss as long as the spot price is below the strike price. The call option buyer has the potential to realize unlimited profits provided the spot price moves higher than the strike price. Though the call option is supposed to make a profit when the spot price moves above the strike price, The call option buyer first needs to recover the premium he has paid. The point at which the call option buyer completely recovers the premium he has paid is called the break-even point. The call option buyer truly starts making a profit only beyond the break-even point, which naturally is above the strike price. Interestingly, all these points can be visualized if we plot the chart of the P&L. Here is the P&L chart of Bajaj Auto's call option trade. From the chart above you can notice the following points which are in line with the discussion we have just had. The loss is restricted to 6 rupees and 35 paise per as long as the spot price is trading at any price below the strike of 2050. From 2050 to 2056.35 break-even price, we can see the losses getting minimized. At 2056.35 we can see that there is neither a profit nor a loss. Above 2056.35 the call option starts making money. In fact, the slope of the P&L line clearly indicates that the profits start increasing exponentially, as and when the spot value moves away from the strike. Again, from the graph one thing is very evident: a call option buyer has a limited risk but unlimited profit potential. And with this I hope you are now clear with the call option from the buyer's perspective. In the next chapter we will look into the call option from the seller's perspective. Key takeaways from this chapter. It makes sense to be a buyer of a call option when you expect the underlying price to increase. If the underlying price remains flat or goes down, then the buyer of the call option loses money. The money the buyer of the call option would lose is equivalent to the premium agreement fees the buyer pays to the seller, writer of the call option. Intrinsic value (IV) of a call option is a non-negative number. IV equals max 0. Spot price, strike price. The maximum loss the buyer of a call option experiences is to the extent of the premium paid. The loss is experienced as long as the spot price is below the strike price. The call option buyer has the potential to make unlimited profits provided the spot price moves higher than the strike price. Though the call option is supposed to make a profit when the spot price moves above the strike price, the call option buyer first needs to recover the premium he has paid. The point at which the call option buyer completely recovers the premium he has paid is called the break-even point. The call option buyer truly starts making a profit only beyond the break-even point, which naturally is above the strike price. 246 responses to buying a call option. AMEHE. Open a ZERODHA account. Chapter 4. Selling, writing a call option. Hindi Gujarati. 4.12 sides of the same coin. Do you remember the 1975 Bollywood super hit flick Diwar, which attained a cult status for the incredibly famous Mere Paas Mahai dialogue smiley face? The movie is about two brothers from the same mother. While one brother, righteous in life, grows up to become a cop, the other brother turns out to be a notorious criminal whose views about life is diametrically opposite to his cop brother. Well, the reason why I'm talking about this legendary movie now is that the option writer and the option buyer are somewhat comparable to these brothers. They are the two sides of the same coin. Of course, unlike the Diwar brothers, there is no view on morality when it comes to options trading. Rather, the view is more on markets and what one expects out of the markets. However, there is one thing that you should remember here: whatever happens to the option seller in terms of the P&L, the exact opposite happens to option buyer and vice versa. For example, if the option writer is making 70 rupees per in profits, this automatically means the option buyer is losing 70 rupees per. Here is a quick list of such generalizations. If the option buyer has limited risk to the extent of premium paid, then the option seller has limited profit, again to the extent of the premium he receives. If the option buyer has unlimited profit potential, then the option seller potentially has unlimited risk. The break-even point is the point at which the option buyer starts to make money. This is the exact same point at which the option writer starts to lose money. If option buyer is making Rs X in profit, then it implies the option seller is making a loss of Rs X. If the option buyer is losing Rs X, then it implies the option seller is making Rs X in profits. Lastly, if the option buyer is of the opinion that the market price will increase above the strike price to be particular, then the option seller would be of the opinion that the market will stay at or below the strike price, and vice versa. To appreciate these points further, it would make sense to take a look at the call option from the seller's perspective, which is the objective of this chapter. Before we proceed, I have to warn you something about this chapter, since there is P&L symmetry between the option seller and the buyer. The discussion going forward in this chapter will look very similar to the discussion we just had in the previous chapter. Hence, there is a possibility that you could just skim through the chapter. Please don't do that. I would suggest you stay alert to notice the subtle difference and the huge impact it has on the P&L of the call option writer. 4.2 Call option seller and his thought process. Recall the AJ venue real estate example from Chapter 1. We discussed 3 possible scenarios that would take the agreement to a logical conclusion. The price of the land moves above 500,000 rupees, good for AJ, option buyer. The price stays flat at 500,000 rupees, good for venue, option seller. The price moves lower than 500,000 rupees, good for venue, option seller. If you notice, the option buyer has a statistical disadvantage when he buys options. Only one possible scenario out of the 3 benefits the option buyer. In other words, 2 out of the 3 scenarios benefit the option seller. This is just one of the incentives for the option writer to sell options. Besides this natural statistical edge, if the option seller also has a good market insight, then the chances of the option seller being profitable are quite high. Please do note, I'm only talking about a natural statistical edge here, and by no way am I suggesting that an option seller will always make money. Anyway, let us now take the same Bajaj Auto example we took up in the previous chapter and build a case for a call option seller and understand how he would view the same situation. Allow me repost the chart. The stock has been heavily beaten down. Clearly, the sentiment is extremely weak. Since the stock has been so heavily beaten down, it implies many investors, traders in the stock, would be stuck in desperate long positions. Any increase in price in the stock will be treated as an opportunity to exit from the stuck long positions. Given this, there is little chance that the stock price will increase in a hurry, especially in the near term, since the expectation is that the stock price won't increase. Selling the Bajaj Auto's call option and collecting the premium can be perceived as a good trading opportunity. With these thoughts, the option writer decides to sell a call option. The most important point to note here is the option seller is selling a call option because he believes that the price of Bajaj Auto will not increase in the near future. Therefore, he believes that selling the call option and collecting the premium is a good strategy. As I mentioned in the previous chapter, selecting the right strike price is a very important aspect of options trading. We will talk about this in greater detail as we go forward in this module. For now, let us assume the option seller decides to sell Bajaj Auto's 2050 strike option and collect 6 rupees and 35 paise per as premiums. Please refer to the option chain below for the details. Let us now run through the same exercise that we ran through in the previous chapter to understand the P&L profile of the call option seller and in the process make the required generalizations. The concept of an intrinsic value of the option that we discussed in the previous chapter will hold true for this chapter as well. Serial No. Possible values of spot premium received intrinsic value IV P&L premium IV 011990 plus 6.35 1990 to 2050 equals 0 equals 6.35 to 0 equals plus 6.35 02 2000 plus 6.35 2000 to 2050 equals 0 equals 6.35 to 0 equals plus 6.35 03 2010 plus 6.35 2010 to 2050 equals 0 equals 6.35 to 0 equals plus 6.35 04 2020 plus 6.35 2020 to 2050 equals 0 equals 6.35 to 0 equals plus 6.35 05 2030 plus 6.35 2030 to 2050 equals 0 equals 6.35 to 0 equals plus 6.35 06 2040 plus 6.35 2040 to 2050 equals 0 equals 6.35 to 0 equals plus 6.35. 07 2050 plus 6.35 2050 to 2050 equals 0 equals 6.35 to 0 equals plus 6.35. 08 2060 plus 6.35 2060 to 2050 equals 10 equals 6.35 to 10 equals 3.65. 09 2070 plus 6.35 2070 to 2050 equals 20 equals 6.35 to 20 equals 13.65. 10 2080 plus 6.35 2080 to 2050 equals 30 equals 6.35 to 30 equals 23.65. 11 2090 plus 6.35 2090 to 2050 equals 40 equals 6.35 to 40 equals 33.65. 12 2100 plus 6.35 2100 2050 equals 50 equals 6.35 to 50 equals 43.65. Before we proceed to discuss the table above, please note, the positive sign in the premium received column indicates a cash inflow credit to the option writer. The intrinsic value of an option upon expiry remains the same irrespective of call option buyer or seller. The net P&L calculation for an option writer changes slightly. The logic goes like this. When an option seller sells options, he receives a premium, for example 6 rupees and 35 paise per. He would experience a loss only after he loses the entire premium, meaning after receiving a premium of 6 rupees and 35 paise. If he loses 5 rupees per, it implies he is still in profit of 1 rupee and 35 paise per. Hence, for an option seller to experience a loss, he has to first lose the premium he has received. Any money he loses over and above the premium received will be his real loss. Hence, the P&L calculation would be premium intrinsic value. You can extend the same argument to the option buyer. Since the option buyer pays a premium, he first needs to recover the premium he has paid. Hence, he would be profitable over and above the premium amount he has received. Hence, the P&L calculation would be intrinsic value premium. The table above should be familiar to you now. Let us inspect the table and make a few generalizations to bear in mind. The strike price is 2050. As long as Bajaj Auto stays at or below the strike price of 2050, the option seller gets to make money, as in he gets to pocket the entire premium of 6 rupees and 35 paise per. However, do note the profit remains constant at 6 rupees and 35 paise per. Generalization 1. The call option writer experiences a maximum profit to the extent of the premium received as long as the spot price remains at or below the strike price for a call option. The option writer experiences an exponential loss, as in when Bajaj Auto starts to move above the strike price of 2050. Generalization 2. The call option writer starts to lose money as and when the spot price moves over and above the strike price. Higher the spot price moves away from the strike price, larger the loss. From the above two generalizations, it is fair to conclude that the option seller can earn limited profits and can experience unlimited loss. We can put these generalizations in a formula to estimate the P&L of a call option seller. P&L equals premium, max, 0. Spot price, strike price. Going by the above formula, let's evaluate the P&L for a few possible spot values on expiry. 2023, 2072, 2055. The solution is as follows. At 2023, equals 6.35 max, 0. 2023 to 2050, equals 6.35 max, 0. Minus 27, equals 6.35 to 0, equals 6.35. The answer is in line with generalization 1. Profit restricted to the extent of premium received. At 2072, equals 6.35 max, 0. 2072 to 2050, equals 6.35 to 22, equals minus 15.56. The answer is in line with generalization 2. Call option writers would experience a loss as and when the spot price moves over and above the strike price. At 2055, equals 6.35 max, 0. 2055 to 2050, equals 6.35 max, 0. Plus 5, equals 6.35 to 5 equals 1.35. Though the spot price is higher than the strike, the call option writer still seems to be making some money here. This is against the second generalization. I'm sure you would know this by now. This is because of the break-even point concept, which we discussed in the previous chapter. Anyway, let us inspect this a bit further and look at the P&L behavior in and around the strike price to see exactly at which point the option writer will start making a loss. Serial No. Possible values of spot premium received. Intrinsic value IV P&L premium IV 012050 plus 6.35 2050 to 2050 equals 0 equals 6.35 to 0 equals 6.35. 022051 plus 6.35 2051 to 2050 equals 1 equals 6.35 to 1 equals 5.35. 032052 plus 6.35 2052 to 2050 equals 2 equals 6.35 to 2 equals 4.35. 042053 plus 6.35 2053 to 2050 equals 3 equals 6.35 to 3 equals 3.35. 052054 plus 6.35 2054 to 2050 equals 4 equals 6.35 to 4 equals 2.35. 062055 plus 6.35 2055 to 2050 equals 5 equals 6.35 to 5 equals 1.35. 072056 plus 6.35 2056 to 2050 equals 6 equals 6.35 to 6 equals 0.35. 082057 plus 6.35 2057 to 2050 equals 7 equals 6.35 to 7 equals 0.65. 092058 plus 6.35 2058 to 2050 equals 8 equals 6.35 to 8 equals 1.65. 102059 plus 6.35 2059 to 2050 equals 9 equals 6.35 to 9 equals 2.65. Clearly, even when the spot price moves higher than the strike, the option writer still makes money. He continues to make money till the spot price increases more than strike plus premium received. At this point he starts to lose money. Hence calling this the breakdown point seems appropriate. Breakdown point for the call option seller equals strike price plus premium received. For the Bajaj Auto example, equals 2050 plus 6.35 equals 2056.35. So, the break-even point for a call option buyer becomes the breakdown point for the call option seller. 4.3 Call option seller payoff. As we have seen throughout this chapter, there is a great symmetry between the call option buyer and the seller. In fact, the same can be observed if we plot the P&L graph of an option seller. Here is the same. The call option seller's P&L payoff looks like a mirror image of the call option buyer's P&L payoff. From the chart above you can notice the following points which are in line with the discussion we have just had. The profit is restricted to 6 rupees and 35 paise per as long as the spot price is trading at any price below the strike of 2050. From 2050 to 2056.35 breakdown price, we can see the profits getting minimized. At 2056.35 we can see that there is neither a profit nor a loss. Above 2056.35 the call option seller starts losing money. In fact, the slope of the P&L line clearly indicates that the losses start to increase exponentially, as in when the spot value moves away from the strike price. 4.4a Note on margins. Think about the risk profile of both the call option buyer and a call option seller. The call option buyer bears no risk. He just has to pay the required premium amount to the call option seller, against which he would buy the right to buy the underlying at a later point. We know his risk maximum loss is restricted to the premium he has already paid. However, when you think about the risk profile of a call option seller, we know that he bears an unlimited risk. His potential loss can exponentially increase as and when the spot price moves above the strike price. Having said this, think about the stock exchange. How can they manage the risk exposure of an option seller in the backdrop of an unlimited loss potential? What if the loss becomes so huge that the option seller decides to default? Clearly, the stock exchange cannot afford to permit a derivative participant to carry such a huge default risk. Hence, it is mandatory for the option seller to park some money as margins. The margins charged for an option seller is similar to the margin requirement for a futures contract. Here is the snapshot from the zero to margin calculator for Bajaj Auto Futures and Bajaj Auto 2050 call option, both expiring on the 30th of April 2015. And here is the margin requirement for selling 2050 call option. As you can see, the margin requirements are somewhat similar in both the cases, option writing and trading futures. Of course, there is a small difference. We will deal with it at a later stage. For now, I just want you to note that option selling requires margins similar to futures trading. And the margin amount is roughly the same. 4.5 Putting things together. I hope the last 4 chapters have given you all the clarity you need with respect to call options, buying and selling. Unlike other topics in finance, options are a little heavy-duty. Hence, I guess it makes sense to consolidate our learning at every opportunity and then proceed further. Here are the key things you should remember with respect to buying and selling call options. With respect to option buying, you buy a call option only when you are bullish about the underlying asset. Upon expiry, the call option will be profitable only if the underlying has moved over and above the strike price. Buying a call option is also referred to as long on a call option, or simply long call. To buy a call option, you need to pay a premium to the option writer. The call option buyer has limited risk to the extent of the premium paid and an potential to make an unlimited profit. The break-even point is the point at which the call option buyer neither makes money nor experiences a loss. P&L equals max 0. Spot price, strike price, premium paid. Break-even point equals strike price plus premium paid. With respect to option selling, you sell a call option, also called option writing, only when you believe that upon expiry, the underlying asset will not increase beyond the strike price. Selling a call option is also called shorting a call option, or simply short call. When you sell a call option, you receive the premium amount. The profit of an option seller is restricted to the premium he receives. However, his loss is potentially unlimited. The breakdown point is the point at which the call option seller gives up all the premium he has made, which means he is neither making money nor is losing money. Since short option position carries unlimited risk, he is required to deposit margin. Margins in case of short options is similar to futures margin. P&L equals premium, max 0. Spot price, strike price. Breakdown point equals strike price plus premium received. Other important points. When you are bullish on a stock, you can either buy the stock in spot, buy its futures, or buy a call option. When you are bearish on a stock, you can either sell the stock in the spot, although on a intraday basis, short futures, or short a call option. The calculation of the intrinsic value for call option is standard. It does not change based on whether you are an option buyer, seller. However, the intrinsic value calculation changes for a put option. The net P&L calculation methodology is different for the call option buyer and seller. Throughout the last 4 chapters, we have looked at the P&L, keeping the expiry in perspective. This is only to help you understand the P&L behavior better. One need not wait for the option expiry to figure out if he is going to be profitable or not. Most of the option trading is based on the change in premiums. For example, if I have bought Bajaj Auto 2050 call option at 6 rupees and 35 paise in the morning, and by noon the same is trading at 9 rupees per, I can choose to sell and book profits. The premiums change dynamically all the time. It changes because of many variables at play. We will understand all of them as we proceed through this module. Call option is abbreviated as CE. So Bajaj Auto 2050 call option is also referred to as Bajaj Auto 2050 CE. CE is an abbreviation for European call option. 4.6 European versus American options. Initially, when option was introduced in India, there are 2 types of options available, European and American options. All index options, Nifty, Bank Nifty options, were European in nature, and the stock options were American in nature. The difference between the two was mainly in terms of options exercise. European options. If the option type is European, then it means that the option buyer will have to mandatory wait till the expiry date to exercise his right. The settlement is based on the value of spot market on expiry day. For example, if he has bought a Bajaj Auto 2050 call option, then for the buyer to be profitable, Bajaj Auto has to go higher than the break-even point on the day of the expiry. Even not that the option is worthless to the buyer and he will lose all the premium money that he paid to the option seller. American options. In an American option, the option buyer can exercise his right to buy the option whenever he deems appropriate during the tenure of the option's expiry. The settlement is dependent of the spot market at that given moment and not really dependent on expiry. For instance, he buys Bajaj Auto 2050 call option today when Bajaj is trading at 2030 in spot market, and there are 20 more days for expiry. The next day Bajaj Auto crosses 2050. In such a case, the buyer of Bajaj Auto 2050 American call option can exercise his right, which means the seller is obligated to settle with the option buyer. The expiry date has little significance here. For people familiar with option, you may have this question: since we can anyway buy an option now and sell it later, maybe in 30 minutes after we purchase, how does it matter if the option is American or European? Valid question. Well, think about the AJ Venue example again. Here AJ and Venue were to revisit the agreement in 6 months' time. This is like a European option. If instead of 6 months, imagine if AJ had insisted that he could come anytime during the tenure of the agreement and claim his right like an American option. For example, there could be a strong rumor about the highway project after they signed off the agreement. In the back of the strong rumor, the land prices shoots up and hence AJ decides to exercise his right. Clearly Venue will be obligated to deliver the land to AJ, even though he is very clear that the land price has gone up because of strong rumors. Now, because Venue carries additional risk of getting exercised on any day as opposed to the day of the expiry, the premium he would need is also higher, so that he is compensated for the risk he takes. For this reason, American options are always more expensive than European options. Also, you may be interested to know that about 3 years ago NSE decided to get rid of American option completely from the derivatives segment. So all options in India are now European in nature, which means the buyer can exercise his option based on the spot price on the expiry day. We will now proceed to understand the put options. Key takeaways from this chapter. You sell a call option when you are bearish on a stock. The call option buyer and the seller have a symmetrically opposite P&L behavior. When you sell a call option, you receive a premium. Selling a call option requires you to deposit a margin. When you sell a call option, your profit is limited to the extent of the premium you receive and your loss can potentially be unlimited. P&L equals premium, max, 0. Spot price, strike price. Breakdown point equals strike price plus premium received. In India, all options are European in nature. 337 responses to selling, writing a call option. Satish J. Open a ZERODHA account. Chapter 5. The Put Option Buying. Hindi Gujarati. 5.1 Getting the Orientation Right. I hope by now you are through with the practicalities of a call option from both the buyer's and seller's perspective. If you are indeed familiar with the call option, then orienting yourself to understand put options is fairly easy. The only change in a put option from the buyer's perspective is the view on markets should be bearish as opposed to the bullish view of a call option buyer. The put option buyer is betting on the fact that the stock price will go down by the time expiry approaches. Hence, in order to profit from this view, he enters into a put option agreement. In a put option agreement, the buyer of the put option can buy the right to sell a stock at a price, strike price, irrespective of where the underlying stock is trading at. Remember this generality: whatever the buyer of the option anticipates, the seller anticipates the exact opposite. Therefore, a market exists. After all, if everyone expects the same, a market can never exist. So if the put option buyer expects the market to go down by expiry, then the put option seller would expect the market or the stock to go up or stay flat. A put option buyer buys the right to sell the underlying to the put option writer at a predetermined rate, strike price. This means the put option seller, upon expiry, will have to buy if the put option buyer is selling him. Pay attention here. At the time of the agreement, the put option seller is selling a right to the put option buyer, wherein the buyer can sell the underlying to the put option seller at the time of expiry. Confusing? Well, just think of the put option as a simple contract where two parties meet today and agree to enter into a transaction based on the price of an underlying. The party agreeing to pay a premium is called the contract buyer, and the party receiving the premium is called the contract seller. The contract buyer pays a premium and buys himself a right. The contract seller receives the premium and obligates himself. The contract buyer will decide whether or not to exercise his right on the expiry day. If the contract buyer decides to exercise his right, then he gets to sell the underlying, maybe a stock, at the agreed price, strike price, and the contract seller will be obligated to buy this underlying from the contract buyer. Obviously, the contract buyer will exercise his right only if the underlying price is trading below the strike price. This means by virtue of the contract the buyer holds, he can sell the underlying at a much higher price to the contract seller when the same underlying is trading at a lower price in the open market. Still confusing? Fear not. We will deal with an example to understand this more clearly. Consider this situation between the contract buyer and the contract seller. Assume Reliance Industries is trading at 850 rupees per. Contract buyer buys the right to sell Reliance to contract seller at 850 rupees per upon expiry. To obtain this right, contract buyer has to pay a premium to the contract seller. Against the receipt of the premium, contract seller will agree to buy Reliance Industries shares at 850 rupees per upon expiry, but only if contract buyer wants him to buy it from him. For example, if upon expiry Reliance is at 820 rupees per, then contract buyer can demand contract seller to buy Reliance at 850 rupees per from him. This means contract buyer can enjoy the benefit of selling Reliance at 850 rupees per when it is trading at a lower price in the open market, 820 rupees per. If Reliance is trading at 850 rupees per or higher upon expiry, say 870 rupees per, it does not make sense for contract buyer to exercise his right and ask contract seller to buy the shares from him at 850 rupees per. This is quite obvious since he can sell it at a higher rate in the open market. An agreement of this sort, where one obtains the right to sell the underlying asset upon expiry, is called a put option. Contract seller will be obligated to buy Reliance at 850 rupees per from contract buyer because he has sold Reliance 850 put option to contract buyer. I hope the above discussion has given you the required orientation to the put options. If you are still confused, it is alright, as I'm certain you will develop more clarity as we proceed further. However, there are 3 key points you need to be aware of at this stage. The buyer of the put option is bearish about the underlying asset, while the seller of the put option is neutral or bullish on the same underlying. The buyer of the put option has the right to sell the underlying asset upon expiry at the strike price. The seller of the put option is obligated, since he receives an upfront premium, to buy the underlying asset at the strike price from the put option buyer if the buyer wishes to exercise his right. 5.2 Building a case for a put option buyer. Like we did with the call option, let us build a practical case to understand the put option better. We will first deal with the put option from the buyer's perspective and then proceed to understand the put option from the seller's perspective. Here is the end of day chart of Bank Nifty as on the 8th of April 2015. Here are some of my thoughts with respect to Bank Nifty. Bank Nifty is trading at 18,417. 2 days ago, Bank Nifty tested its resistance level of 18,550, resistance level highlighted by a green horizontal line. I consider 18,550 as resistance since there is a price action zone at this level which is well spaced in time. For people who are not familiar with the concept of resistance, I would suggest you read about it here. I have highlighted the price action zone in a blue rectangular boxes. On 7th of April, yesterday, RBI maintained a status quo on the monetary rates. They kept the key central bank rates unchanged. As you may know, RBI monetary policy is the most important event for Bank Nifty. Hence, in the backdrop of a technical resistance and lack of any key fundamental trigger, banks may not be the flavor of the season in the markets, as a result of which traders may want to sell banks and buy something else which is the flavor of the season. For these reasons, I have a bearish bias towards Bank Nifty. However, shorting futures may be a bit risky as the overall market is bullish. It is only the banking sector which is lacking luster. Under circumstances such as these, employing an option is best. Hence, buying a put option on the Bank Nifty may make sense. Remember, when you buy a put option, you benefit when the underlying goes down. Backed by this reasoning, I would prefer to buy the 18,400 put option, which is trading at a premium of 315 rupees per. Remember, to buy this 18,400 put option, I will have to pay the required premium, 315 rupees per in this case, and the same will be received by the 18,400 put option seller. Of course, buying the put option is quite simple. The easiest way is to call your broker and ask him to buy the put option of a specific stock and strike, and it will be done for you in matter of a few seconds. Alternatively, you can buy it yourself through a trading terminal such as 0 to Pi. We will get into the technicalities of buying and selling options via a trading terminal at a later stage. Now, assuming I have bought Bank Nifty's 18,400 put option, it would be interesting to observe the P&L behavior of the put option upon its expiry. In the process, we can even make a few generalizations about the behavior of a put option's P&L. 5.3 Intrinsic Value (IV) of a put option. Before we proceed to generalize the behavior of the put option P&L, we need to understand the calculation of the intrinsic value of a put option. We discussed the concept of intrinsic value in the previous chapter. Hence, I will assume you know the concept behind IV. Intrinsic value represents the value of money the buyer will receive if he were to exercise the option upon expiry. The calculation for the intrinsic value of a put option is slightly different from that of a call option. To help you appreciate the difference, let me post here the intrinsic value formula for a call option. IV call option equals spot price strike price. The intrinsic value of a put option is IV put option equals strike price spot price. I want you to remember an important aspect here with respect to the intrinsic value of an option. Consider the following timeline. The formula to calculate the intrinsic value of an option that we have just looked at is applicable only on the day of the expiry. However, the calculation of intrinsic value of an option is different during the series. Of course, we will understand how to calculate and the need to calculate the intrinsic value of an option during the expiry. But for now, we only need to know the calculation of the intrinsic value upon expiry. 5.4 P&L behavior of the put option buyer. Keeping the concept of intrinsic value of a put option at the back of our mind, let us work towards building a table which would help us identify how much money I, as the buyer of Bank Nifty's 18,400 put option, would make under the various possible spot value changes of Bank Nifty in spot market on expiry. Do remember the premium paid for this option is 315 rupees per. Irrespective of how the spot value changes, the fact that I have paid 315 rupees per will remain unchanged. This is the cost that I have incurred in order to buy the Bank Nifty 18,400 put option. Let us keep this in perspective and work out the P&L table. Please note, the negative sign before the premium paid represents a cash outflow from my trading account. Serial No. Possible values of spot premium paid intrinsic value IV P&L IV plus premium 01161953151840016195 equals 2205 plus minus 315 equals plus 1890 02165103151840016510 equals 1890 plus minus 315 equals plus 1575. 031682531518400 equals 1575 plus minus 315 equals plus 1260. 041714031518400 equals 1260 plus minus 315 equals plus 945. 051745531518400 equals 945,945 plus minus 315 equals plus 630. 061777031518400 equals 630,630 plus minus 315 equals plus 315. 071808531518400 equals 315,315 plus minus 315 equals 0. 081840031518400 equals 00 plus minus 315 equals 315. 091871531518400 equals 00 plus minus 315 equals minus 315. 10190303151840 equals 00 plus minus 315 equals minus 315. 11193453151840 equals 00 plus minus 315 equals minus 315. 12196603151840 equals 00 plus minus 315 equals minus 315. Let us make some observations on the behavior of the P&L and also make a few P&L generalizations. For the above discussion, set your eyes at row number 8 as your reference point. The objective behind buying a put option is to benefit from a falling price. As we can see, the profit increases as and when the price decreases in the spot market with reference to the strike price of 18,400. Generalization 1. Buyers of put options are profitable as and when the spot price goes below the strike price. In other words, buy a put option only when you are bearish about the underlying. As the spot price goes above the strike price, 18,400, the position starts to make a loss. However, the loss is restricted to the extent of the premium paid, which in this case is 315 rupees per. Generalization 2. A put option buyer experiences a loss when the spot price goes higher than the strike price. However, the maximum loss is restricted to the extent of the premium the put option buyer has paid. Here is a general formula using which you can calculate the P&L from a put option position. To bear in mind, this formula is applicable on positions held till expiry. P&L equals max 0. Strike price, spot price, premium paid. Let us pick two random values and evaluate if the formula works. 16,510. 19,660. At 16,510, spot below strike. Position has to be profitable. Equals max 0. 1840016510315 315 equals 1890 to 315 equals plus 1575. At 19,660, spot above strike. Position has to be loss-making. Restricted to premium paid. Equals max 0. 18400196603 315 equals max 0. Minus 1,260, 315 equals 315. Clearly, both the results match the expected outcome. Further, we need to understand the break-even point calculation for a put option buyer. Note: I will take the liberty of skipping the explanation of a break-even point as we have already dealt with it in the previous chapter. Hence, I will give you the formula to calculate the same. Break-even point equals strike price, premium paid. For the Bank Nifty, break-even point would be equals 18400,315 equals 18,085. So as per this definition of the break-even point, at 18,085 the put option should neither make any money nor lose any money. To validate this, let us apply the P&L formula. Equals max 0. 18400-18085 315 equals max 0. 315 equals 315 to 315 equals 0. The result obtained and clearly in line with the expectation of the break-even point. Important note: the calculation of the intrinsic value, P&L, and break-even point are all with respect to the expiry. So far in this module, we have assumed that you as an option buyer or seller would set up the option trade with an intention to hold the same till expiry. But soon you will realize that more often than not, you will initiate an options trade only to close it much earlier than expiry. Under such a situation, the calculations of break-even point may not matter much. However, the calculation of the P&L and intrinsic value does matter, and there is a different formula to do the same. To put this more clearly, let me assume two situations on the Bank Nifty trade. We know the trade has been initiated on the 7th of April 2015 and the expiry is on the 30th of April 2015. What would be the P&L assuming spot is at 17,000 on the 30th of April 2015? What would be the P&L assuming spot is at 17,000 on the 15th of April 2015, or for that matter any other date apart from the expiry date? Answer to the first question is fairly simple. We can straightway apply the P&L formula. Equals max 0. 18400-17315 equals max 0. 1400 315 equals 1400 to 315 equals 1085. Going on to the second question. If the spot is at 17,000 on any other date apart from the expiry date, the P&L is not going to be 1085. It will be higher. We will discuss why this will be higher at an appropriate stage. But for now, just keep this point in the back of your mind. 5.5 Put option buyers P&L payoff. If we connect the P&L points of the put option and develop a line chart, we should be able to observe the generalizations we have made on the put option buyers P&L. Please find below the same. Here are a few things that you should appreciate from the chart above. Remember, 18,400 is the strike price. The put option buyer experienced a loss only when the spot price goes above the strike price, 18,400 and above. However, this loss is limited to the extent of the premium paid. The put option buyer will experience an exponential gain as and when the spot price trades below the strike price. The gains can be potentially unlimited. At the break-even point, 18,085, the put option buyer neither makes money nor loses money. You can observe that at the break-even point, the P&L graph just recovers from a loss-making situation to a neutral situation. It is only above this point the put option buyer would start to make money. Key takeaways from this chapter. Buy a put option when you are bearish about the prospects of the underlying. In other words, a put option buyer is profitable only when the underlying declines in value. The intrinsic value calculation of a put option is slightly different when compared to the intrinsic value calculation of a call option. A put option equals strike price, spot price. The P&L of a put option buyer can be calculated as P&L equals max 0. Strike price, spot price, premium paid. The break-even point for the put option buyer is calculated as strike, premium paid. 95 responses to the put option buying. R.P. Hans. April 20th, 2015 at 9:43 a.m. Hello Kartik. I want to open a ZERODHA account. Chapter 6. The Put Option Selling. Gujarati. 6.1 Building the Case. Previously we understood that an option seller and the buyer are like two sides of the same coin. They have a diametrically opposite view on markets. Going by this, if the put option buyer is bearish about the market, then clearly the put option seller must have a bullish view on the markets. Recollect, we looked at the Bank Nifty's chart in the previous chapter. We will review the same chart again, but from the perspective of a put option seller. The typical thought process for the put option seller would be something like this. Bank Nifty is trading at 18,417. 2 days ago, Bank Nifty tested its resistance level at 18,550. Resistance level is highlighted by a green horizontal line. 18,550 is considered as resistance as there is a price action zone at this level, which is well spaced in time. For people who are not familiar with the concept of resistance, I would suggest you read about it here. I have highlighted the price action zone in a blue rectangular boxes. Bank Nifty has attempted to crack the resistance level for the last 3 consecutive times. All it needs is one good push, maybe a large-sized bank announcing decent results. HDFC, SEC, and SBI are expected to declare results soon. A positive Q plus a move above the resistance will set Bank Nifty on the upward trajectory. Hence, writing the put option and collecting the premiums may sound like a good idea. You may have a question at this stage: if the outlook is bullish, why sell a put option and why not just buy a call option? Well, the decision to either buy a call option or sell a put option really depends on how attractive the premiums are at the time of taking the decision. If the call option has a low premium, then buying a call option makes sense. Likewise, if the put option is trading at a very high premium, then selling the put option and therefore collecting the premium makes sense. Of course, to figure out what exactly to do, buying a call option or selling a put option depends on the attractiveness of the premium. And to judge how attractive the premium is, you need some background knowledge on option pricing. Of course, going forward in this module we will understand option pricing. So, with these thoughts, assume the trader decides to sell the 18,400 put option and collect 315 rupees as the premium. As usual, let us observe the P&L behavior for a put option seller and make a few generalizations. Do note, when you write options, regardless of calls or puts, margins are blocked in your account. We have discussed this perspective here, request you to go through the same. 6.2 P&L behavior for the put option seller. Please do remember the calculation of the intrinsic value of the option remains the same for both writing a put option as well as buying a put option. However, the P&L calculation changes, which we will discuss shortly. We will assume various possible scenarios on the expiry date and figure out how the P&L behaves. Serial No. Possible values of spot premium received: intrinsic value IV, P&L premium IV 01-16195 plus 315-18400-16195 equals 2205-315-2205 equals 1890. 02-16510 plus 315-18400-16510 equals 1890. 315-1890 equals 1575. 03-16825 plus 315-18400-16825 equals 1575. 315-1575 equals 1260. 04-17140 plus 315-18400-17140 equals 1260. 315-1260 equals 945. 05-17455 plus 315-18400-17455 equals 945. 315 to 945 equals 630. 06-17770 plus 315-18400-17770 equals 630. 315 to 630 equals 315. 07-18085 plus 315-18400-18085 equals 315. 315 to 315 equals 0. 08-18400 plus 315-18400-18400 equals 0. 315 equals plus 315. 09-18715 plus 315-18400-18715 equals 0. 315 equals plus 315. 10-19030 plus 315-18400-19030 equals 0. 315 equals plus 315. 11-19345 plus 315-18400-19345 equals 0. 315 equals plus 315. 12-19660 plus 315-18400-19660 equals 0. 315 equals plus 315. I would assume by now you will be in a position to easily generalize the P&L behavior upon expiry. especially considering the fact that we have done the same for the last 3 chapters. The generalizations are as below. Make sure you set your eyes on row 8 as it's the strike price for this trade. The objective behind selling a put option is to collect the premiums and benefit from the bullish outlook on market. Therefore, as we can see, the profit stays flat at 315 rupees premium collected as long as the spot price stays above the strike price. Generalization 1. Sellers of the put options are profitable as long as the spot price remains at or higher than the strike price. In other words, sell a put option only when you are bullish about the underlying or when you believe that the underlying will no longer continue to fall. As the spot price goes below the strike price, 18,400, the position starts to make a loss. Clearly, there is no cap on how much loss the seller can experience here, and it can be theoretically be unlimited. Generalization 2. A put option seller can potentially experience an unlimited loss as and when the spot price goes lower than the strike price. Here is a general formula using which you can calculate the P&L from writing a put option position. Do bear in mind this formula is applicable on positions held till expiry. P&L equals premium received, max 0. Strike price, spot price. Let us pick 2 random values and evaluate if the formula works. 16,510. 19,660. At 16,510, spot below strike. Position has to be loss-making. Equals 315 max 0. 18400-16510. Equals 315-1890. Equals 1575. At 19,660, spot above strike. Position has to be profitable. Restricted to premium paid. Equals 315 max 0. 18400-19660. Equals 315 max 0. Minus 1,260. Equals 315. Clearly, both the results match the expected outcome. Further, the breakdown point for a put option seller can be defined as a point where the put option seller starts making a loss after giving away all the premium he has collected. Breakdown point equals strike price, premium received. For the Bank Nifty, the breakdown point would be equals 18400-315 equals 18,085. So as per this definition of the breakdown point, at 18,085 the put option seller should neither make any money nor lose any money. Do note this also means at this stage, he would lose the entire premium he has collected. To validate this, let us apply the P&L formula and calculate the P&L at the breakdown point. Equals 315 max 0. 18400-18085. Equals 315 max 0. 315. Equals 315 to 315. Equals 0. The result obtained and clearly in line with the expectation of the breakdown point. 6.3 Put option sellers payoff. If we connect the P&L points as seen in the table earlier and develop a line chart, we should be able to observe the generalizations we have made on the put option seller's P&L. Please find below the same. Here are a few things that you should appreciate from the chart above. Remember 18,400 is the strike price. The put option seller experiences a loss only when the spot price goes below the strike price. 18,400 and lower. The loss is theoretically unlimited, therefore the risk. The put option seller will experience a profit to the extent of premium received as and when the spot price trades above the strike price. The gains are restricted to the extent of premium received. At the breakdown point 18,085, the put option seller neither makes money nor loses money. However, at this stage he gives up the entire premium he has received. You can observe that at the breakdown point, the P&L graph just starts to buckle down from a positive territory to the neutral, no profit, no loss situation. It is only below this point the put option seller starts to lose money. And with these points, hopefully you should have got the essence of put option selling. Over the last few chapters we have looked at both the call option and the put option from both the buyer and seller's perspective. In the next chapter we will quickly summarize the same and shift gear towards other essential Concepts of options. Key takeaways from this chapter. You sell a put option when you are bullish on a stock or when you believe the stock price will no longer go down. When you are bullish on the underlying, you can either buy the call option or sell a put option. The decision depends on how attractive the premium is. Option premium pricing along with option Greeks gives a sense of how attractive the premiums are. The put option buyer and the seller have a symmetrically opposite P&L behavior. When you sell a put option, you receive premium. Selling a put option requires you to deposit margin. When you sell a put option, your profit is limited to the extent of the premium you receive and your loss can potentially be unlimited. P&L equals premium received, max 0. Strike price, spot price. Breakdown point equals strike price, premium paid. 117 responses to the put option selling. Jargons. April 29th, 2015 at 6:28 a.m. Thanks Kartik for your reply on my previous question and also for the next chapter. My question is, open a ZERODHA account. Chapter 7. Summarizing call and put options. Gujarati. 7.1 Remember these graphs. Over the last few chapters we have looked at two basic option types, i.e.